Hello, everyone. Good morning, good afternoon, and good evening, depending where you are in the world. Thank you for tuning in, and thank you to our sister company, IP Global, for having us on their webinar series that looks at property in a post-COVID world. I'm Ben Wilshire, Associate Director in the Investor Relations and Business Development team at IP Investment Management, and I will be the moderator for today. For those of you who don't know IPIM, we're a sister company of IP Global and a private equity real estate fund manager. We invest in direct, institutional quality real estate assets in developed markets, and the team has invested over $500 million worth of real estate transactions to date. Just to be clear, the content of this presentation should not be considered investment advice or an offer to invest in any particular product. Before making any investment decisions, please consult an independent advisor. Today's topic of discussion is US multifamily real estate. And we asked the question, could it outperform following the COVID-19 pandemic, as it has done in prior crises? More specifically, could suburban multifamily stand to benefit from post-COVID trends? To discuss these topics, I'm pleased to be joined by Kai Huang, Associate Director in our investment team, and Jay Ballard, Managing Director, Multi-Housing Capital Markets at JLL. So Kai is originally from the US, and he has over 14 years of real estate experience, having previously worked at Mapletree Investments, CBRE, and Credit Ease. Kai oversees management of several of IPIM's investments, is involved in portfolio management and product design, and sits on our investment committee. Jay is based in Orlando, which means it's a very early start for him today, so an extra thank you for joining us at this time. Jay is a veteran of the Central Florida market, having been involved in over $6 billion worth of real estate transactions throughout the course of his 36-year career, including land and apartment portfolio sales, as well as equity and debt project funding. And his clients include public and private companies, institutional investors, and REITs. Kai and Jay are going to cover a few points. First of all, what is multifamily? What categories of multifamily properties are there? How has it performed historically compared with other assets like office, retail, and hotels? And what emerging trends it could stand to benefit from in the future? For instance, renter behavior is changing now that people are more likely to be working from home. So I'm sure some of you will have questions, so do please enter them into the question box that you see on your screen. We'll do our best to answer them at the end of the webinar. Now I'd like to hand over to Kai, who will start by looking at what we know about the impact of COVID-19 so far and what benefits direct real estate investment can offer right now. Over to you, Kai.
Hi, Ben. Thank you very much for the intro. Very much appreciated. Hi, everyone. Thank you for joining our webinar today. Much appreciated. Currently, I'm sure as everyone knows that we currently live in very unprecedented times, right? It's no secret that it's no secret that the pandemic has caused global economic disruption. And as such, we've experienced heavy, extreme market volatility, which I'm sure some of you have personally, been impacted by. And of course, looking forward, we feel that it's paved the way for uncertain times ahead. Okay. As far as the way its impact on people, we've noticed that COVID-19 has affected the way how people make choices, right? And how that manifests itself is really the way how people decide to live, work, and ultimately how they end up spending the money, okay? And one of the things going forward that we have realized, during this tumultuous time is that we've seen that there has been demand for, resilient investments that would attract, that hopefully could generate attractive risk-adjusted returns, hopefully beating and hedging against inflation. And obviously, there would be the end goal being preserving wealth, okay? And this is generally the problem that we're kind of seeing as a result of this whole situation, surfacing. Looking ahead as a potential solution, to this problem, we, as direct real estate investment managers, do believe that direct real estate can and is a solution as an investment type that may generate attractive risk-adjusted returns in this market, especially with respect to U.S. multifamily, more specifically the suburban multifamily segment. Okay, since COVID-19 has happened, in late Q1 till now, we've witnessed that multifamily has been relatively quite resilient during this whole pandemic, as evidenced by high rental collection rates. And going forward, we feel like we have high conviction and confidence that suburban U.S. multifamily is very well positioned to really capitalize a lot of the on a lot of the demographic trends that have been emerging. Especially when you take into account migration patterns. Okay, with that in mind, generally what we're noticing is a resurgence of suburban areas, in which has been an ongoing trend since 2016, where you do have a lot of maturing millennials that have been moving out into the suburban markets, outside, away from your so-called tier 1 24/7 global gateway cities, into your so-called secondary and tertiary markets, which a lot of which tend to be more suburban in nature. Okay, a lot of this is basically the general trend is millennials moving out from expensive, densely populated tier 1 cities into more affordable secondary, tertiary markets as a way to improve the quality of life, and also layering in COVID-19, taking into account the work from home policies, which obviously has accelerated this trend, in addition to the need to social distance. Okay. This slide generally, make no mistake, shows you very clearly what the COVID-19 impacts has been on population in the U.S. From both a economic and health perspective. Obviously, quite severe, and also you could kind of see how this kind of compares to other recessions, such as the GFC, in terms of the number of jobs lost. And of course, it kind of gives you a relative sense of its impact based on what has happened in the past during the Great Depression. Okay. So as a result of COVID-19, what has happened? Well, you've had the major governments, not just in the US, but worldwide, that have actually intervened, right? They've intervened in a very meaningful way. So basically, you've had a lot of governments who who have implemented both monetary and fiscal policy. With respect to interest rates, the Fed has recently announced or had reduced the cut interest rates in Q1, and more recently have announced that interest rates will be kept at near zero for the foreseeable future until 2022. In addition, you do have large stimulus bills that have been signed. The $2 trillion CARES Act, which was intended to help prop up the economy, and to support local and state governments, small businesses throughout the country, and of course households at that level too as well. So next slide. What could we expect ahead going forward, right? Certainly, it's a very tricky situation, very uncertain times that we're dealing with here. As you can see, we would be expecting high unemployment. We would be expecting lower corporate profits as a result, right? People not being able to, not having jobs and having the money to go out and spend on goods and services as a result of such mass unemployment. As a result of both fiscal and monetary policies that have been implemented, we have increased money printing, which we think that inflation will increase substantially, potentially. Of course, interest rates, we're in a very low interest rate environment. Who knows, maybe we may even dip into negative interest rates going forward, okay? Market is expected to remain quite volatile going forward, depending on, how the whole virus situation, plays out. And as such, again, as evidenced from the Fed's outlook, we think that we're on the road for a slow economic recovery as a result of them keeping, interest rates down to near zero for 2 years. Okay, it is very uncertain and unclear as to when we will be able to get, vaccine or viable treatment option available for everyone. And going forward, as states, reopen and close and reopen and close, we believe that there will be, social distancing will be very, very likely that it will be, continued. So we kind of, from the perspective of investors such as yourselves, you may be thinking in the forefront, what are my priorities during times of uncertainty? What should I think about, right? And what we recommend is that, there's obviously, like I said, demand for resilient investments that would hopefully help to, help you guys preserve capital. Ideally, if you could, find investments that will generate stable cash flows and predictable cash flows, and also, hedge against inflation, that's obviously most ideal, okay? So what are your options? Basically, I've pretty much laid out your safe haven, so-called safe haven investment options out here, right? And typically during times of uncertainty, investors will tend to flock toward either, keeping, cash, or, buy precious metals, maybe physical, perhaps in this context, may look to buy government bonds, or invest in more hard and real assets such as direct real estate. Okay, this slide basically outlines all the the more qualitative benefits to why we think direct investments are great investment options going forward, especially during these times. And the benefits of it would include anything from having low correlation to public markets, stable real estate assets that may be able to generate in stable cash flows and yield, and the fact that for direct real estate, the way how leases are structured, there's the ability to structure potential to structure long-term leases that have built-in annual or annual rent increases or escalations either every year or every few years. And the fact that with direct real estate, the manager has the ability to to make key decisions and actively manage the underlying assets such that there's the ability to increase the probability of a most favorable outcome as it relates to the asset valuations over time. Okay, so moving on, here I'd like to kind of highlight how direct real estate has actually performed over the span of last 20 years relative to what is your so-called traditional assets, right? Equities, traditional assets being either equities or fixed income. In this, these two, charts and graphs, I am specifically focusing on, the U.S. context, right? U.S. bonds, U.S. equities, U.S. REITs, and U.S. direct real estate of all sectors. One thing to note here on the graph on the left is you could kind of see over time that direct real estate, U.S. real estate assets as a whole has outperformed U.S. equities in terms of higher returns for a substantially less amount of standard deviation risk. Okay, and relative to U.S. real estate investment trusts or REITs that are also basically publicly listed and traded, public companies that own and operate underlying real estate assets. You can see that REITs have outperformed direct real estate in terms of returns. However, that being said, at a cost of about 4 times the amount of volatility, right? So this is something to really kind of consider in terms of looking into your investment portfolio and in considering other asset exposures and types. Okay, looking into correlation over the last 20 years, interestingly enough, you do see that direct real estate has very low correlations, right? Sub 0.3 to both, equities, which would, include listed U.S. REITs, and it has moved, opposite direction in terms of bonds, okay, over time. So things to kind of really consider and think about. So you're thinking, okay, well, the U.S. real estate, sure, but what is the investment universe, right? If one were to want to get exposure into real estate, where could they actually, how can they invest their money, and what type of real estate sectors can they target? Here I've listed out basically the four main food groups, right? Retail, office, apartments, and industrial. And taking into account and layering in how they've actually performed, qualitatively throughout the whole COVID-19 side, as this pandemic has been playing out. Okay, with retail and industrial, these asset sectors, basically a mixed bag. Okay, with retail, those assets, shopping malls and centers that tend to have more tenants that are of retailers that sell discretionary spending items have suffered. Okay, and you'll see that later in the context of rental collection rates. But however, those retail shopping centers and grocery anchored malls and strip malls have actually done relatively well, given the fact that they focus on tenants that have and sell non-discretionary spending items, right? Groceries and household goods. Okay. Industrial has also performed, mixed performance too as well. Industrial, the subset of industrial could either be manufacturing plants and logistics and distribution warehouses. In the context of the U.S., we've witnessed that there have been manufacturing plants that have had to shut down as a result of the pandemic. So that the businesses can actually implement and enforce social distancing. One notable case would be Tyson's Food. It's a food and meat processing plant in which Tyson had at least 5,000 plus of its workers infected, over 15 different states. So therefore, a lot of these type of plants would have to kind of shut down, right, in order to avoid having the virus spread more. Now, on the other flip side, if you do look into things like or tenants such as Amazon, mostly focus on e-commerce, they've actually flourished and actually benefited during COVID-19. So as evidence of by them hiring more than 175 new employees to keep up with demand, you can imagine that as a landlord for e-commerce, industrial distribution warehouses, you could be sure that you would be able, Amazon could be able to pay the rent, right, given how well the business is doing. With office, it's been, we do see headwinds, namely because of the work from home policies that a lot of companies have been able to implement. Okay, so companies like Twitter, Facebook, Square, those are more tech companies. Other companies like banks, financial services, a lot of working professionals have the ability and the wherewithal to work from home, given the fact that their companies have been able to, invest in the infrastructure to do so, right? So that kind of puts into question whether if people do see the need to actually, return back to their office, and even if states have been reopening, people remain hesitant to kind of go back to the office for fear of getting infected. Right? So office, we think, is obviously going to see some headwinds. Apartments, which we're focused on, we're quite, we think that it should be pretty compelling, due to many of the emerging trends. Like I said before, there's, if you look at the migration patterns, there are strong demographic trends that are underpinning, future rental demand, especially in times like these where job security may be very uncertain. And the fact that because people can actually work from home, they may seem to obviously move out to suburbs and implement and practice social distancing and working from home during these uncertain times. Like I said, with job security, we believe that there, for the foreseeable future, in the near short term, you do have a lot of tenants who may think on holding back on home buying and purchases, given the fact that they may, or it is pretty uncertain how what the economic outlook may be, right, and whether if there's any forward to actually put down a down payment and buy a home. Okay, so that's basically the U.S. Investment universe that we have here. So in talking about multifamily, I'd like to kind of just lay it out and unpack what multifamily is. For those who may not be very familiar with multifamily is, it's basically a residential building that has more than one residential unit under the same roof. And in the context of the U.S., you have 4 different type of formats and layouts, the way how multifamily is laid out and developed and constructed. Multifamily, what it does is it offers tenants, amenitized and hassle-free living, under rent, in flexible lease terms, and these assets are, tend to be professionally managed, where you have one landlord that owns the building in its entirety and owns and operates and manages it on a day-to-day, ensuring that that the tenants are provided the best services as possible, right? In terms of their living situation. So basically, you have garden-style apartments, predominantly located in suburban markets, mid-rise and high-rises, which tend to be more urban. And then, of course, mixed-use projects, which are, combine the best of both commercial and residential uses in one development. It's all more or less integrated, right? So generally, that's what multifamily is. In terms of the various investment strategies and classes, I've laid them all out here. In terms of investment strategies, you have 4 types, ranging from core, core plus, value add, and opportunistic. If you're looking from left to right, you can see the risk and reward profiles are, as you progress, further to the right, it becomes obviously higher risk reward. Core assets, I'm sure, obviously is the extreme left, obviously in that case, which would mean mature, stabilized real estate assets, well located, with high quality tenants, generally tend to be, so-called more institutional grade, offering very predictable cash flow on a monthly basis. And it's not to say that, opportunistic wouldn't be able to offer that. It's just a different type of investment strategy, right? Opportunistic, on the other end of the extreme, being more, could be the construction, ground up greenfield developments, or it could also consist of projects that are more on the redevelopment or heavier value add, right? And we define value add as your more so-called fixer-uppers, in a more colloquial, terminology. Below, you can see the various classes that we have: Class A, B, and C. These, multifamily classes all have different, they're classified in their own respective categories based on, vintage or location, the quality of fixtures and, finishes, the amount of amenities that they have, the amount of, its overall condition too as well, right? If they're for maintenance or not, or it's newly constructed. So Class A, B, and C, which I think is relatively self-explanatory, okay? So just to kind of give you an understanding of, snapshot of the U.S. multifamily market size, it's a very big market, right? Very deep, very liquid. It's a $4 trillion market, okay? Which would comprise, and just to kind of give you an understanding of scale, there are about 14.5 million units, multifamily units, that are spread across over to various largest metros throughout the U.S., okay? Just last year alone, year-end 2019, according to JLL Research, the U.S. multifamily market has transacted about 167 billion worth of assets alone in that year, so pretty sizable. Very, very mature asset class. We do have a lot of, bunch of U.S. multifamily REITs that are listed on the New York Stock Exchange that are trading at, multi-billion US dollar market caps, okay? On a more forward-looking basis, you do see, there's high demand for multifamily products, right? More, there's high renter demand, such that, it's been predicted, or basically, in addition to the current existing inventory, there is the need to actually have 4.6 million additional new units by 2030 in order to keep up with ongoing renter demand going forward. Okay, so very sizable market, and it's highly liquid. A lot of institutional, very, very large and deep pool of institutional buyers, investors in both the debt and equity space too. So just to let you know. So moving into COVID-19, right? How has multifamily fared in COVID-19? From here, in this slide, basically showcase rental collection rates, right? And what does that mean? That means of the amount of occupied tenants landlords have in their properties, what percentage can these landlords of these their tenants can they actually what percentage have they been able to collect their rents from, right? And you can see from this slide, multifamily and industrial have done quite well and held up pretty well during the month of April and May. July figures from the National Multifamily Housing Council, July 2020, have also showed it's about 95% too as well. So it's doing quite well, in light of what's been kind of going on relative to office and obviously retail, as I mentioned, has taken a hit. Okay. So I guess looking backwards as a case study, we've taken the liberty to kind of examine how multifamily has fared during and after the 08 GFC. You could see that multifamily has experienced the least amount of cumulative rent decline at close to 8%. And once once we've started recovering and reaching past pre-GFC peaks, you could see that multifamily rental growth has grown close to 26%, right? Which is about 3 to 5x the amount of what industrial and office has, their rent has grown cumulatively over during the same period. Okay. Looking in terms from a time scale, right? Again, during the same period, we could see here's a breakdown between the 4 major food groups of how how their rent trends, the rent trends that they've actually experienced, and the time that's associated with each trend. Those trends being negative growth, rental growth, growth to return, and of course growth once we've reached past rent levels reminiscent of the prior peak and onwards. And basically in the slide, to sum it up, you could kind of see that multifamily has experienced the least amount of negative rental growth, right? 5 quarters. Multifamily has experienced, is the quickest to recover, right? Has experienced 7 consecutive quarters. It only took 7 quarters for multifamily to reach its prior peak. And then following that, during the recovery stage, multifamily has actually grown for 29 consecutive quarters onwards, right? Which is more substantial than what you see in industrial and office, basically. So obviously the testament, taking into account the last GFC, recession, how multifamily has fared, okay? So you're probably wondering why we're talking about suburban US multifamily. And this slide here basically lays out some of the observations that not only we have seen, but a lot of other consultants have also seen, and what the media has kind of caught on to as well. And like I was saying, what we have seen is that COVID-19 has accelerated the trend, for a lot of, and it's driven by maturing millennials who have been historically since 2016 moving out from the suburbs into tier 2 and tier 3 markets for both lifestyle and financial reasons, right? And of course, obviously some of the observations that we noted, taking COVID-19 into account, right? Basically, it's people who live and work in expensive, densely populated CBDs in their office buildings downtown. As a result of this virus coming out and playing out, there's a lot of people who are wary about not going back to the office, assuming that they were open, and of course they are wary about getting getting infected either through elevators, right, small enclosed spaces, or exposing themselves potentially to the virus if they're taking mass transit day in day out for their commute. Other companies who have implemented and who have allowed people to work from home has also accelerated that. As a result, people do realize and come to the conclusion that they're not bound geographically to CBDs. So therefore, a lot of them have been considering moving away or have been moving away from the CBDs in search for more space, better quality of life, more and affordability in the suburbs, in tier 2-3 markets that obviously offer a much lower cost of living. Okay, and some of the things that we've also noticed is that as a result of COVID-19, because you have work from home policies, assuming there's going to be a need for increased size of units, homes and apartment units, right? Because assuming that there's dual income households, and layering in the fact that kids, a lot of schools are closed and kids have to remain at home, it's just a need for more space, right? Especially for home offices, right? Until this whole pandemic plays out. Other more demographic-oriented implications would be decreased apartment sharing, less roommates, and perhaps an increase in multi-generational living as a result of what has happened in a lot of the senior housing homes, right, where virus has been affecting the older generation too as well, and people may reconsider having their loved ones go reside in senior nursing homes as a result of that. Okay, so to sum it up, why do we think suburban U.S. multifamily investment is compelling? Well, I mean, generally 3 main reasons. It's a secure asset class, it's a real asset, right? It's a hard asset that exhibits a lot of qualities that safe haven investments may have. It's highly resilient, as demonstrated from past recessions, and as demonstrated from high rental collection rates, and is a sector that we feel, due to emerging demographic trends, that is well positioned to capitalize on a lot of these trends, right? In terms of migration patterns to suburbs, less demand to live and work in crowded, densely populated, and expensive CBDs going forward. And we think post-COVID-19, this is a sector that should be able to capitalize on all these type of trends. So that pretty much is what I have to say about suburban U.S. family.
Kai, thanks a lot for all of that. That was really, really useful. I mean, we're obviously very eager to hear from Jay, but just before I pass over, Kai, I mean, you've talked about U.S. multifamily, U.S. suburban multifamily as a market, but it's a big market. So what, could you just sort of highlight quickly a couple of geographies that be more interesting than others, or potentially could outperform other markets?
Yeah, great. Yeah, absolutely. So U.S. multifamily, yes, it's a large market. The markets over the last year or so that we here at IPIM have been focused on have been your high growth markets, predominantly in the Sun Belt region of the U.S. Right. So that involves anywhere from Mid-Atlantic states to Florida and Texas. Okay, and a lot of this has been also potentially driven due to also the tax side of the equation too as well. A lot of these other bi-coastal 24 gateway city markets like New York and California tend to have progressive tax rates systems, whereas Florida and Texas, there's no income state taxes, right? So from a financial perspective, obviously there's the people kind of attracted by that, especially in light of tax changes that happened back in 2017. Okay, so that's just tax, financial. Other factors to kind of consider would be the job availability, the housing, right, quality of life, weather, right, or there's a lot of other more qualitative factors. I guess to kind of case in point, currently we do have high conviction of markets such as Florida. We do currently have we have a 288 unit multifamily ground up development, Class A, in Daytona submarket that currently we're capital raising for. And this is obviously a testament, right? This is how we're actually really, literally, for lack of a better way of expressing, putting our money where our mouth is with this, right? So, and I think it's just, going forward, it's most likely going to kind of continue for that. And of course, Florida and Texas have been the states that have seen, for the last few years, some of the largest population growth. So with more population comes, results in more job growth, and of course, a lot of companies will take into that, will catch on to that trend, and therefore they will look to invest their investment dollars into building out a more significant presence in these type of high growth markets.
Great, thanks very much, Kai. So at this point, I'd like to hand over to Jay. He'll be able to share some of his and JLL's views and draw from some of his experience on the sector. Over to you, Jay.
Thank you, Ben. So I'm pleased to participate in this conference this morning. It's quite interesting as we all navigate globally the impact of COVID. One of the things that is really quite telling is that over the last 15 to 20 years that multifamily housing as an asset class against office, industrial, and retail has generally proven to be one of the least volatile and the most desirable investment classes. Historically, it was not a very institutional investment. In other words, the majority of multifamily properties throughout the country historically have been owned by smaller private investment groups, firms, mom and pops, and year over year for the last 10 to 15 years, it has grown as a desirable asset class amongst major institutional investors. It's also provided historically the highest average annual return according to NCREIF, as the slide shows here. And then when you look at the capital and the income as a percentage of total returns, you take a 288 unit or 300 unit apartment complex, you have that many individual leases. You have a 100,000 square foot office building with 10,000 square foot leases, you only had 10 times to change the rent. Same with retail and industrial, depending upon the size of the tenant base at the property. So with an apartment community, you have individual leases that if the market is starting to show growth, you have the ability, you probably have as much as anywhere from 40 to 60% annual turnover in the leases, which provides an opportunity to grow the rents. So you go to the next slide. So again, following the global crisis, the financial crisis of the mid-2000s, the market value of multifamily has soared exponentially and has recovered quite well over the last 11 quarters. One of the most interesting factors is that the demand for multifamily, driven by the individual renters that are there, as well as the demand by investors to buy that asset class against the other asset classes, has what's really led to the financial crisis. It's been buoyed as well by the global interest rate market. And in the last 2 to 3 years, cap rates on multifamily investment properties have continued to be driven down, which means that the value for the assets across all vintage classes, core, as Kai was pointing out, core plus, value add, has continued to have downward pressure on cap rates, which translates into upward pressure on market value for the assets. So it has been sustained, it has been growing, and continues in the current environment, even post-COVID, to see the same trends continuing. Next slide. So this is the one slide that we all use as a comparative analysis. However, you know, in today's day and age, I certainly don't stand here in front of you suggesting that I have any crystal ball into how the recovery is going to happen, except to say that in Central Florida, over my 36-year career, that following every crisis that I've been around to participate in, we have had more of a LIFO mentality. In other words, from an accounting perspective, we've been the last to enter into any market softness and one of the first to get out of the softness. I think by definition of these comparisons here and previous recoveries of other epidemics, you can see a V shape, which shows that after bottoming out, it calls for a reasonably sharp rebound. And the real estate industry itself is experiencing a disruption on a major scale, and multifamily, in our opinion, should be the asset class that survives, as well as any of the other three food groups. Next slide. So I think as Kai also pointed out, based on the size of the multifamily market, and namely attributable in the United States to the available financing mechanisms through our government-sponsored entities, Fannie Mae and Freddie Mac, as well as the life insurance companies, multifamily remains a very liquid market. Commerce closures in March leading into the COVID environment did see a slight decline in the first quarter. However, post 4th of July weekend, we have seen a flood of multifamily assets to the market by investors who are desirous to test the waters and see if they can sell. There's also a tremendous amount of capital available for investors to invest in multifamily. I think everyone who was taking a wait and see approach for the first 90 to 120 days of the crisis, and as we think we see some trends starting to settle out, we believe that the third quarter and even the fourth quarter should pick back up in terms of transaction volume and investment in traditional apartments. Next slide. So this slide kind of points out the location of markets and the tranches that investors will target. So again, as Kai pointed out, that there's been a move geographically. Florida is now the third most populous state, surpassing New York. And due to our low no state income tax and low overall tax rate, we have seen an increase in population and job growth over the last 5 to 10 years. And what that's done is that's put us on the radar screen for the major institutional investors to target investment in multifamily in the Florida markets. Specifically, we found that a secondary and a tertiary market, so in many cases, Orlando would be a secondary market for many institutional investors, and someone like a Daytona or other suburban market in proximity to Orlando would be classified as a tertiary market. Well, we have seen, due to the lack of volatility in those markets, investors betting heavily on the growth in those markets. So we have transacted asset sales over the last 2 years in more of those secondary and tertiary markets due to the investor demand and the competition for assets in the primary markets. So people are chasing yield by moving to markets like that, and they also find that there's less volatility and cyclicality to those markets as an investment alternative. Next slide. So even in Central Florida, we have seen on a relative basis a robust amount of urban construction in the recent years. That's typically being done by more institutional investors. We have in Central Florida currently some 2 different real estate investment trusts building in an urban environment, while the more national and regional multifamily developers have been pursuing development of suburban multifamily properties, which are 3- and 4-story surface parked and 4-story cases, elevator served properties. The urban environment will continue to be there, but we definitely are seeing more of a flight to the suburbs by the resident population, namely because they want to live in more proximity to where the jobs are. In a market like Florida, unless you're in Miami or certain elements of South Florida or even Tampa, which is a bigger MSA than Central Florida, you're going to find the suburban location where more horizontal development, I guess I would say, you'll find more suburban proximity to jobs and housing and retail that supports all that. So we think that that is going to continue to be a trend moving forward, and it provides people with the more of an alternative as opposed to living in a more urban dense environment as we deal with the COVID scenario, which may, people maybe want to distance themselves from people in general. So next slide. And, going back over the last year or so, we're all seeing just the direct result of market performance and asset performance that the suburban markets generally are outperforming the urban core as tenants do seek affordability. So it's not difficult to understand that the more urban environment, the more expensive it's going to be. And as you move out into the suburbs, you might get a larger unit. In a more urban environment, you typically have, in a 300-unit apartment complex, the average unit size of the entire project is going to be a smaller square footage. Whereas in a suburban location, you actually have the ability to see an average of maybe 150 to 250 square foot larger units. So that provides a bigger unit for the family if there is some multi-generational living there and or in-home work from home scenarios. It just provides a better alternative. And then as a percentage of the monthly rent, concessions have been less rampant in the suburban product than in urban product. Next slide. This is another very interesting statistic. And again, I think there was a reference to it by Kai in his earlier comments that JLL collects research from over 1.5 million renters through institutional owners around the country. And the rent collection through mid-month of the last 3 months, April, May, and June, show that we have sustained collections. There are there is a by product type and market type, there is a higher percentage of collection in the secondary markets than the primary markets overall. And I think in asset class, the Class A and Class B, where you would expect that the tenants that live in those properties have a better paying job and are less susceptible to a service sector or lower wage paying job. So ergo, you would have a higher collection in those properties. So it's very easy to get very granular and look at these things, but this is the depth and breadth that we go to deal with our investors and suggest where they consider looking at opportunities. Next slide.
Jay, and just to to ask there, I guess also the Class A properties, they're more likely to the tenants will be more likely right now to be able to work from home and to continue be, I suppose, less at risk in terms of their jobs and as opposed to Class B and Class C.
Well, exactly, Ben. I think your point is that the type of job that those residents have allows them to work from home. If they are a service sector based employee that requires them to be physically present in a location, that's not something that one can do from one's home. So by virtue of the type of job, absolutely the work from home scenario provides a better alternative. That's a great point. All right, next slide. Declining rent relief requests or offers are growing from the tenant and operator confidence. So we have seen specifically with one large third-party property management firm here in Central Florida that has approximately 17,000 units in one particular portfolio that they manage. Less than 4% of their residents asking for some sort of rent relief or concession. And I think that this is a really important slide to see and understand that when you look in the chart on the left at the share of occupied units that are requesting rent relief, amongst the various asset classes hovered under 3%. What I think you'd find today is that that number has declined. So in terms of the statistic that I just gave you, the rent relief is either somebody on a payment plan, somebody making a partial payment, or somebody that's not paying their rent at all. And I think that overall, as an industry, ownership and property owners and management companies are very focused on this and are feeling like we're given the severity of the COVID crisis, we feel very, very well positioned relative to the other asset classes. Next slide. So emerging trends that we're seeing, I think we've talked about it just a second ago, concessions and rent deferrals. That is something that we're dealing with. It's a very de minimis perspective against the overall income at a property. Generally speaking, the suburban product is outperforming the more urban environments. One of the things that's an unknown out there is that some cities and counties and states throughout the country have enacted legislation to temporary stay evictions. So there's a moratorium by the government, and in some instances in bigger cities in the West Coast and the Northeast, residents have actually kind of organized and created rent strikes. So that raises a rent control debate. It's another reason that Florida's economy, which is not susceptible to that rent control that, say, New York or San Francisco or even LA might experience, makes it a more favorable and desirable location for investment in multifamily. And then last slide, really, I think we talked about this a second ago, is that investors have been increasingly deploying capital in secondary and tertiary markets, and that's basically been a result of their desire to chase yield. In the more urban environments, the limited number of assets in the Florida markets that fit that category mean that the cap rates on those assets are going to be uber competitive, and the cash and cash returns and levered returns are going to be maybe a little more hampered, whereas the suburban garden deals have provided stable growth and have not been the pricing, while increased due to competition, has not been pushed up to the point that it doesn't make any economic sense to invest in the deals. So that we think that's going to be a continuing trend to chase suburban deals in secondary markets. Next slide. So, the COVID impact on future demand. I think really the work from home model that seems to be being adopted both from a business standpoint and from individuals, which is directly a result of the health-driven changes and economic changes, I think is going to be something that is going to have a large impact on multifamily going forward. So on the very bottom row, what you'll see is that from a health standpoint, we think that means that as developers build new communities, they're going to consider changing the designs. You may have larger unit sizes, the floor plans to allow maybe a remote working environment. The clubhouse designs in the properties will change a little bit due to the social distancing and isolation requirement. From an economic standpoint, the creditworthiness of the tenant is going to continue to be a very, very important aspect of the investment. And then lastly, from a strategic standpoint, reduction of property management costs. I think what we historically have seen is a higher turnover in multifamily properties. Historically, as I said, somewhere in the 50 to 65% range. If people continue to move to suburban environments and decide to stay and not move around, you could see a reduction in operating costs relative to lower turnover. And we're seeing that in some cases already just in the short time we've been dealing with COVID. Next slide. So, operation strategies in terms of several apartment communities that we've been involved with. One that we're marketing for a developer. It's a brand new property. It's in lease up. They have leased 100 units since April 20th in Central Florida on a brand new property. The first 45 days of the lease up, they were doing FaceTime leasing tours where the manager or the leasing assistant would basically speak to you on your phone, much like we're doing right now. It doesn't matter, we're all in various places around the world, which is just remarkable. And they would walk you through the unit based on the type you would see. They would walk you through the clubhouse. They would show you the amenities. You would physically not have any direct interaction with somebody, not even maybe until the day that you moved into your property. So I think that was a very interesting modification of strategies. Rent collection is continuing to be something that operators are working with tenants on. Package security, the ability to have a package system at a property which takes the delivery of the unit, the packages that we all get from Amazon every day, away from the property managers and eliminates the fact that, oh, the Amazon guy dropped it off and the manager put it behind someone's desk and it's not there. It's like having a mini post office at the property. I think that's a very, very increased trend that we'll see more and more. And it also has an aspect of it for food delivery. Amazon is doing package systems that many multifamily properties are involved in. They actually have cold and heat storage lockers that you can order your food and come home from work and go get it out of your locker and just go right to your unit. On site, you know, all the regional and national management firms are using hygiene and disinfection protocols and being extremely focused on keeping common area spaces clean and elevators and amenity rooms and delivery rooms. Unit maintenance, there's been probably more of a limit on emergency issues for COVID. The maintenance workers have been practicing a social distancing, and they're really just dealing with emergency maintenance routine requests by residents. And then the summer leasing season, typically, and this is something that I think is still to play out. Historically, the late spring to the early fall is a time where a lot of leasing activity happens due to people either having school-age kids and trying to be in a property for a certain school district and moving. So I think given the COVID situation, the question about back to school, summer leasing season, at least on the one asset that we're working on specifically that I referenced, it's at least 100 units in the last 90 days, seems to be picking back up in Central Florida. So I think we're going to continue to see some strong demand. And I think the next slide, I don't know if that's the last slide or not. This is just a quick slide that depicts the rent declines in past cycles in the major Florida markets overall. From the dot-com era to the financial crisis, you can see the change in market by market. Orlando has had a disproportionate amount of rent decline in the financial crisis versus the dot-com crisis, namely due to our tourism and hospitality component of our GDP. Jacksonville, a port city in the Northeast, has had a disparity between dot-com and the financial crisis, and then Southeast Florida, Palm Beach, Fort Lauderdale, Miami, more urban environments, more densely populated, probably so a little less susceptible. Next slide. So, you know, interesting scenario. The impact speed to recovery, the ability to turn around after any one of these crises, the cyclicality of Florida's market may differ. And I think what you find is that the three main choices are the counter-cyclical, the diversified, the highly cyclical recovery. And that those are really driven by the types of businesses that support those regions. So whether it's federal government, contracting, lobbying, and the counter-cyclical class, a diversified economy, consumer products, professional services, or highly cyclical finance, technology, and energy, you can see the cluster of the major other markets outside of Southeast Florida and Miami that fall into that. And so we believe that the the average amount of time for recovery from pre-crisis peak to trough is going to be much smaller.
So Jay, on that slide, how would one of the tertiary markets like Daytona fit into this sort of category of counter-cyclical, diversified, highly cyclical?
Well, I think the important thing to consider is that when you get into a more suburban location, you just typically are going to have a more generally diversified economy. You're not, for example, in Central Florida, year over year, relative to say Daytona, everyone knows Orlando is the theme park capital of the world, but many people from around the world are surprised to learn that the tourism and hospitality aspect of our GDP, while it used to be much bigger, it used to be as much as 35%, a third of the economy. Today, it's situated at about 27%. You compare that to someplace like Daytona, which people know maybe from one of the world's most famous beaches to the home of the Daytona 500 and the big racing season. It also has an incredible amount of higher education, universities, medical facilities, and other regional growth businesses. So it's less dependent on any one aspect, and it means that I think it is poised to have a bigger rebound. And people that live there for lifestyle, and most likely due to the proximity to some sort of employment, whether it's Embry-Riddle University, which is a well-known aviation-based and aeronautical technical school, to some of the hospitals that serve in that area. So I think the diversification of those means that while it seems highly cyclical, it actually means that it will rebound quicker. Next slide, I guess.
Okay.
Again, this slide really just kind of depicts how Florida entered this downturn in a strong position. The economy was running on all cylinders pre-COVID. Central Florida specifically had led the state in job and population growth. So I think what you'll see relative to other major MSAs around the country, that our unemployment lows are were in check, if not some of the lowest in the country. And when you look at the unemployment numbers now, I think in every one of those cases, it is somewhat artificially inflated due to the impact of COVID. And again, as we talked about on one of the earlier slides, I think that we'll see a rebound of that, somewhere between sharp and somewhere between the Nike swoosh. There were no fundamental credit policy issues or fractures in the financial markets. So as we come out of this health crisis, jobs will recover, and they should return to generally historical low unemployment. And then again, this is just more specific, kind of the same slide with the specific reference to the major MSAs in Orlando, or in the state of Florida: Orlando, Jacksonville, South Florida, and Tampa Bay. The percentage of growth and job growth and population growth in Florida is expected to continue and recover post-COVID. Again, this kind of just speaks to that. The returning employment growth, we think, will trigger a surge in absorption and provide a mechanism for occupancies to continue to increase. We have had historically high occupancies in multifamily. We have had historical average deliveries that are still not meeting the demand in the market. So I think that the artificial vacancies we're seeing right now related to COVID issues will eliminate itself once we come out of this crisis, and we think that there'll be more movement into multifamily as an alternative for asset classes if maybe somebody had to move home due to a job loss, living with mom and dad, or living with multiple family units under the same roof. At some point, people will go back to their independence, and we think that that's going to be a positive. Next slide. You know, the buy side benefit that occurs during a transaction volume trough. I think that we're going to see probably less of a dip as you see in the peak trough there in 09 and 010 in the current cycle, just due to the fact that there was no real economic fracture in the fundamental market of multifamily. And so I think there is more dry powder on the sidelines right now than there's been in any time in the last 36 years. And people are expecting, and just as an example, my partner in the Tampa market just took out a brand new asset the Monday or Tuesday after the 4th of July weekend. And in 3 days, it's a brand new lease up deal. It's fully stabilized. It was built in late 18 and early 19, 95% occupied, 96% leased. They had 95 confidentiality agreements from investors in 3 days. We might have 95 to 120 confidentiality agreements over a 3 to 4 week marketing period. So I think that investors have been sitting on the sidelines waiting for opportunities to see. That's a core asset in a well-located suburban location in the Tampa market. And I think that just is a testimony to the demand for product by investors in this cycle.
Well, Jay, that's an interesting point, because I think, you know, a lot of people will be thinking, there must be a lot of distressed opportunities out there at the moment, and are you seeing any of that, or is it I suppose depending on the geography and the class of asset, but is that something that you're seeing at the moment or not?
Well, I think it's a great question, Ben. I think everybody everybody thinks there will be a certain element of distress, and I think that the longer I do this, the more I know what I don't know. And what I would tell you is that historical experience would tell me that there should be some distress in the market. I think, again, due to the strength of the market leading into this cycle, that I think we've had, in the case of the government entities, Fannie Mae and Freddie Mac, which are two of the biggest lending partners in multifamily space across the country, they have worked with property owners if they have assets that are having some challenges. I think over the last 5 to 6 years, the underwriting of assets has not been like it was in the 07, 08, 09 crisis, where assets were highly leveraged, as high as 80 or 90% leveraged. That didn't allow any wiggle room for a property if it started having performance issues. Leverage today hovers in the 60 to 70% range. So that extra cushion, I think, has helped. There's no doubt that also some of the other issues affecting the crisis and the global crisis in the mid-2000s to late 2000s was the preponderance of the CMBS loans and the bundling of mortgages across asset classes and classified as all A tranches, and we've come to find out that they weren't. So I think in today's cycle, if we find any distress or we see any fractures in the performance, it's probably something that's going to lag by 4 to 6 to 8 months, really due to the propping up of the economy by the federal government. So I think at the present time, we're not seeing any issues per se, but everyone's keeping a mindful eye on what that may look like in 6 to 8 months. And I don't think that if it does show up, that it will be as deep or wide as it was in the late 2000s.
Thanks for that, Jay.
So this slide really kind of just depicts the elevated rent growth and diminishing concession packages as we talked about. This is a simple perspective to look at markets around the country from a supply and demand standpoint. And most of these cities are, as I think Ben or Kai referenced, what we call the smile cities, which is from the mid-Atlantic of the United States down into Florida and then over into Texas, the Sun Belt cities, if you will. And the amount of concessions that are burned off for these high growth markets has averaged about 7% from the peak of when this chart reflects the time frame. So I think the average concession reduction is important to understand because it's really a simple supply and demand variable. And if there are more people renting apartments, there are less concessions being offered. It's normal in a new construction project for there to be a half a month to 1 month of concession as an enticement to get a resident to move in. But it's usually on a 12 to 13 month lease. And so it doesn't have any real overall impact on the initial pro forma. It's considered baked in, if you will, when a developer builds a property to put a concession in there so he has that in his toolbox to use it. If he doesn't have to, then that's just all the better. But I think this just shows the effect of rent growth and diminishing amount of concessions and how that we think that trend continues going forward. You know, first mover advantage following a downturn really suggests, kind of like we were talking about a second ago, the amount of interest on the recent listing that my colleague in our Tampa market took out shows the ability to possibly get into an investment early. Some people would think that it's a really artificial stimulus today, but with overall interest rates being as historically low as they've been and no expectation that they will rise exponentially for the foreseeable 2 to 3 years, we think that that's going to continue to spur investment and demand, meaning that the leverage that investors can put on these properties will allow them to get into assets as we come out of the cycle right now. So when you look at the number of starts in the cycles, on average, you look at the number of deliveries and you look at the actual demand for rent growth, you'll see, quite honestly, in this chart, how as you go from left to right on the very bottom, the average cap rates have continued to face downward pressure. And we think that that is going to actually continue. And then as a market like Central Florida matures, we have seen cap rates. I got a phone call from an investor 2 weeks ago from New York on the very pretense of, oh, you know, we're looking for an opportunity. You know, we've got $150 million of equity we want to deploy, and we're looking for a 6.5 cap. And I kind of just sat there for a second and just let him finish his comment. And then I said, I don't understand. And he said, well, what do you mean? And I said, we haven't seen a 6.5 cap in Central Florida for 12 or 13 years. I mean, what makes you think you're going to go find that in the market? So I think that, you know, as an asset class, you know, there just are so many variables that support multifamily as a desired asset, as a more desirable asset to invest in, and less susceptibility to the vagaries of traditional real estate, you know, like the sticks and bricks in the real retail world, or changes that may come out of office by virtue of the potential collapse of WeWork and the co-working spaces. Work from home, and people are going to need a place to put a roof over their head. So I think it ends up morphing into being your primary residence and also a primary office. So it's going to be curious to see how that plays out going forward. Next slide. Again, this just speaks to the, very similar to the chart 2 or 3 ago, just shows the amount of deliveries historically in the purple line versus the light tan line that shows the multi-housing starts. They're not out of whack with each other, and as we show the rise from 09, 010 to where we are today, the amount of capital that's available to invest in multifamily and the liquidity that's there, it mirrors the favorable supply and demand economics that are there, and we think that that will continue going forward. Next.
Okay, well, thanks very much, Jay. That was really interesting. I think we are running a little bit over, so thanks everyone for sticking around to the end. You know, I think we'll take a few questions that have come in. So you know, just looking here, sort of. So, you know, as an investor, what would be, you know, what are obviously the different ways to get exposure to the sector? You know, you could invest into a specific development, you could invest into stocks from the listed developers. What are your thoughts on I suppose, the different ways to essentially benefit from the sector as a whole?
Am I taking this question again?
I think that's to Jay, but Kai, feel free to comment as well.
All right, sorry.
Well, go ahead, Kai. I think it really kind of speaks more to the vehicle and the mechanism that you have relative to what we see. But I'll certainly I'll comment after you speak.
Yeah, I mean, I guess it just really depends, right? I mean, if someone were to go out and buy into, let's say, a U.S. multifamily REIT, what are you really buying? You are actually buying, I guess, diversification, right? But to the extent that you could actually control exactly where you want your capital to be invested, you are looking, right? So, for example, there are, like I said earlier, there are billion-dollar market cap REITs that are specifically investing in multifamily, but they may be investing nationwide, and it may be, could be more heavily concentrated towards CBDs, for example, right? So for those type of, if you don't want exposure to CBDs, but you're trying to find REITs, you got to look carefully, right? And that's one consideration. And the other is that, like I said back, what I alluded to earlier in my presentation, that once you buy shares of a publicly listed traded REIT, you are subject to potential volatility. And with volatility comes the fact that you may be subjecting yourself as an investor to 4 times the amount of volatility that you would have otherwise if you were to invest in, let's say, a direct real estate project that's a bit more targeted and concentrated toward a specific market, and because you're investing due to other underlying fundamentals that you think has ability to potentially outperform a lot of other markets out there. So these are the considerations that I would think would kind of drive how an investor may look to approach how to invest in money and which markets to pick, which vehicles.
Great, thanks, Kai. Jay, I don't know if you want to comment, but we've got there's also another one that's come in. What about, we've talked about multifamily, what about single family rental homes, and how do they sort of fit into the picture, and what are the, things to look at? I mean, that's, to both of you, so feel free to comment.
It's a very interesting question. I think one of the trends that we're seeing that's evolved out of the last 6 to 8 months is traditional multifamily operators, and we've seen it in the large private equity firms like Blackstone and others who have gone long in owning individual single family homes as a portfolio. What we're seeing now is we're seeing traditional multifamily operators and developers seek to find development opportunities to build a single family rental community, much like an entire subdivision. And multifamily as an asset class has long faced something that we call NIMBYism, not in my backyard. But that's usually something that's misconstrued, and people don't understand the value of a multifamily apartment community as an alternative stepping stone maybe to a single family home ownership scenario. They think it brings in a bad element. Not everybody that lives in an apartment community is a criminal. It increases tax bases for the communities that the assets are located in. Usually the entire apartment community is self-contained, meaning that in a single family subdivision, the cities and counties, those are public roads, so they have to take care of the maintenance of the roads, the water, and the sewer. In an apartment community, everything that's within the boundaries of the property is the responsibility of the owner of the apartment community. So that's an interesting transition that we're starting to see. It's happened down in the West Coast in California and Phoenix specifically, where large national operators and developers have built or are building single family rental communities as an alternative to a little bit more of the social distancing and the spreading out, as opposed to being even a suburban garden apartment community has a little bit of a density feel to it. So it just depends. So I think it's a fair question. I think the mechanism for doing that, I think you'll see some of the more traditional owners and developers take a greater interest in moving forward in that asset class. I think to try to buy a house individually, if that's not something that you're experienced in doing, it's like anything else. I think it sounds great on paper, but there's a lot of nuances and considerations, especially depending upon where one's located, in terms of having local representation, a handyman, maintenance people. You're gonna get that phone call in the middle of the night that my toilet's clogged and what do I do? And you're a half a world away. So I think those are all things that one needs to consider when making any investment in real estate. Kai, I don't know if you want to add to that.
Yeah, no, I mean, I think you've pretty much covered it. Yeah, I mean, look, SFR, single family rental home communities, obviously has been an uptick in interest in that, and we've witnessed that too as well. In fact, I've looked at some other SFR type of deals, Texas and in Nashville, Tennessee, all both very high growth markets. We could understand the appeal of SFR, and generally speaking, it is it's more or less the same thing as multifamily. However, each self-contained unit, there's an additional variable about each unit being its own self-contained unit. But if it's being professionally managed and leased and operated, it's very there's this kind of a slight difference to multifamily, but nonetheless quite interesting as it relates to the residential sector at large, that we think should do quite well in the next foreseeable few years going forward in general. So
great. Well, thank you very much. I think with that one we'll look to wrap up. I mean, thank you very much for tuning in. Thanks, Kai. Thanks, Jay. Thank you for everyone of us at IPIM. Unfortunately, we don't have time to answer all the questions, but if you just let us get back to you, we can respond in person as well. There will be slides available. If you like a copy, just send us an email, and there will be a recording as well if you missed anything. Thanks, everyone, and have a good rest of the day.